The broadcast is now starting. All attendees are in listen-only mode.
Good evening. Welcome to Admiral Markets webinar. My name is Chris. Neneth and I are going to take a look at this topic, understanding what the market is communicating to us. That is the topic of today. Before we dive into that, though, please be aware of our Twitter handles. If you're on that platform, you can follow us with all the newest analysis there. All right. First of all, though, be aware that this webinar is shown to a global audience, but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity for more info on that. Please also be aware that trading foreign exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer, and you are aware of the risk involved when trading. Great. Thank you so much for your attention. Neneth and myself, happy to have this webinar with Admiral Markets. Admiral Markets has done a lot of work with the MetaTrader 4 Supreme Edition, a lot of extra features there, and of course also you can find on the website admiralmarkets.com a lot of analytics, a lot of education, a lot of articles that help your trading. So take a look at that after the webinar and see what that can do for you regarding all kinds of topics. Today's topic is going to be about basically understanding some key things in a way, our trading psychology. They're all kind of interconnected here. And first of all, I want to discuss why we have a bias and how that occurs, how that basically kind of kicks off, that process starts, and why that's important. The topic of today is basically know what the market wants, right? That's the headline of the webinar. Know what the market wants. Know what the market wants by listening. And often, basically, the problem with the fact that when I say listening, I mean the fact is that we look at the markets, we analyze the markets, and eventually we come to a sort of conclusion. We know what we're looking for, let's say, but we then get a sort of attachment to a particular analysis, to a particular trade, and that's when we kind of lose the, let's say, neutral perspective. We get a bias. We kind of attach our ego to it. As the analysis is either confirmed or invalidated, we are either happy or sad, and it kind of hurts maybe a bit of our ego for some of you, not for everyone necessarily, if the analysis is not kind of proven correctly. So we're kind of riding or placing our own personal interest at stake in a trade. Now, it's not for everyone, but if we feel that attachment, and it's not necessarily that strong for everyone, sometimes it's a bit of milder form. Maybe you feel not that your ego is connected to it, and maybe you don't even recognize that, but let's say it's not, you would still feel that level of attachment to that particular trade, which is not necessary, right? Where the market is concerned, it's all about executing a trade, following the trading plan, analyzing the market, but that changes. The market changes, so we should be adapt as well, rather than keeping hope, keeping kind of connection and hoping that will still turn into our favor. The trade will still materialize as we expected. It's much more kind of suitable for us to be adaptive, to be flexible, and at the right times, of course, not too soon either, see that the market is changing and the market is not confirming what we expected at first, and we have to reanalyze the market and review it and see it from a different lens. When that happens, when we don't do that, we see the market as wrong, we're right, and the market should prove that we're right. And that's when we get emotional and we get either into a very negative spiral or we get overly excited, right, as this image shows. So that's a bit of the problem with biases. It kind of blinds us from looking at the charts as we normally would. To be honest, if we're looking at the charts without being in the trade, we have a neutral kind of calmness to that situation. We analyze it, and often that's a lot more fair. It's a lot more balanced, Once we get in the trade, it seems like we cannot have that same view, and we just lose that perspective, and we can't get that back anymore. That's that bias that is kind of coloring our glasses pink. We just can't see the candles, whether they're blue or red, or whether they're black or white anymore. And that's something we have to remove. And that's very critical for not only trade management. Of course, I talk specific now about already being in the trade, but it's also even valid if we're not in a trade. If we do our analysis, right, and we have a certain expectation, a trade expectation, we're bullish, for instance, right? And we're not even in the trade, but we're already attached to our analysis, and we keep that analysis, that attachment alive. So we're still hunting for a long, but maybe the market environment has changed in the meantime. So it's actually valid for both. Prior to the entry, when we're hunting, when we're attached to our analysis, and during the entry, when we're attached to our live trade and don't want to accept kind of what's the reality of that, the fact that the trade is just not going our way. All right, enough about that. When looking at the market, price can go in any direction. There is no guarantee for anything. There is really nothing we can say. And obviously we can do our best. We can look at patterns. We can try to define or build strategies. And that should give us that edge that we need for the long term. But any particular situation, any particular moment, and any trade, it can go anywhere it wants to price. There's no such thing as this setup must work out. Forget about that, right? So in my view, the market is like a wind. It could turn at any point, it could pivot to the left, and it could accelerate and slow down. But there are certain things we can look at, for instance, weather forecast, to have a good judgment about the speed of that day on average and what the direction will be on average that day. So that's great info. But does every single part of the weather forecast for the city have to be exactly that wind speed, exactly that wind direction for the entire city, the entire day? No. Right? So that's a bit like the strategy is the weather forecast, but the wind is kind of that individual setup, right? So I see the market as neutral. As a thought experiment, I've asked traders to provide an answer how they see the market, and I get all kind of answers like it's a shark, it's a lion, so it's more like aggressive kind of animals. Basically, if you look at it that way, you'll try to basically compensate that. Still subconsciously you'll think there's some kind of danger around the corner lurking, and I think it doesn't make you relaxed as a trader, right? Now, too relaxed is not good either, and I understand that maybe relax is a bit of a high goal, but if you really want to find that kind of middle ground where you're sharp and focused, but not full of anxiety, right? And that's that sweet zone where I think you'll digest the information as quickly and as well as you can without breaking into a sweat. Anyhow, the best what we can do is make a best guess. It's all about probability, and we're not that good in probabilities as humans. In fact, we have a bit of difficulty doing that, although we do that actually every day subconsciously when we, for instance, drive our car to get to work maybe, or if you drive your car to buy groceries, you're already estimating what the travel time could be of the traffic jam and whether that's a good moment or not. That's a probability. It's a forecast, right? So we do that, but many things are quite constant and don't change or are very unlikely. So we don't think about that too much. We're not that good in dealing with probability. And that's throughout all walks of life. I read a book once. I'm struggling to find I wish, no, I don't remember. And the book cabinet is, I cannot see it from here. But um, that book, unfortunately, I don't know the name, but it said that even doctors, for instance, have difficulties with probabilities, assessing what the likelihood is of what could happen to a human, right? So in all kind of fields, it's difficult to realize probability. For instance, if someone says there's a 70 to 30% chance that something's going to happen, there's still a large chance that that's going to happen. If that happens, the forecast does not have to be necessarily incorrect. And many people think it's incorrect because it's 70 to 30. So grasping that is very difficult. But in trading, it's very important. People who play poker know that a 2 out of 3 versus a 1 out of 3, you still lose a lot, all right? So for those people that play poker, it is a bit easier to imagine those odds and deal with that. So very critical is to look at the chance versus reward to risk ratio. What is the probability? What kind of reward can I get? And how many pips am I risking? And how many pips can I win? That's always the most important factor, or a very important factor when looking at this. All right. And when new info comes, we have to realize how that balance changes. And that's something that we don't have to do every single candle. I don't want to be overly nervous at the beginning of the trade. I want to give some time to a trade. I also want to give time to my analysis to unfold as well. So that's valid for pre-entry and after entry. You don't want to be too nervous and exit the trade or forget your analysis after one candle. But there is a point, and I often, depending on the situation, definitely give 5 candles the time, 5 to 6 candles. In other cases, when I'm already in the trade, I might give up to 24 candles the time for it to develop. But the longer it takes, the more demanding you want to become, and the more that new info you want to weigh in, and you want to be more critical about the trade, and you want to be play the devil's advocate in understanding whether this is still the same initial analysis, or are you fooling yourself and things changed in the meantime. So some solutions from my perspective before Nana takes over. Problems during analysis. So in my point of view, it's very critical to see trading as a dance. And with that I mean that if the market is leading, we need to follow that market. We should not be leading the market and hope that the market is following us. So from a conceptual point of view, I think you understand, right? In most of the dances, someone is leading and the other one is following, if you have a couple dance, right? So the trader should be one following the signals, should be following the lead of the market. Always keep that in mind. Now, the way I do that is by using decision zones and triggers at those zones. That's basically my way of saying, okay, if price reaches, now it's in the middle of nowhere, it's between 2 trend lines, I want it to reach one of those 2 trend lines and either break or bounce at those trend lines. The trend lines are decision zones, for instance. The triggers at those trend lines could be a turn of the CCI. It could be candlestick pattern. It could be a break of a fractal on a lower time frame. There are a lot of things we can think about. This is something we've discussed in other webinars, so I will leave it at that for the moment. Second solution for entries is looking at basically what I call instinctive and critical thinking. So instinctive thinking is quick, it's impulsive, it's a type 1 thinking from a theoretical point of view. Critical thinking is slow, deliberate, it's called type 2 thinking. It's something where we really think about the pros and cons, the disadvantages, advantages. We really consciously stop and think about the situation and everything around it. Type 1 is subconscious. It's quick, it's a gut feeling, it's something that just pops out of nowhere in a way, right? And we don't put any time into it. We'll have times that we basically have a lot of instinctive thinking. But there are a lot of problems with that. Problems of the instinctive thinking is that we react based on emotions. Basically the reaction is based on fear or greed or hope. And sometimes, of course, gut feelings are also based on experience, pattern recognition built over the months and years by looking at the charts. And that's fine. So all instinctive feeling is not bad, don't get me wrong. It's just the more experience you have, the better that will become. The solutions to that are to check your instinct. Instead of reacting right away on it, is to double and triple check it. Go with that instinct. Use it to your benefit, but check it. Be critical. Be your own. Try to think about someone else who would be a neutral person, and from that perspective, look at the charts. Well, if you carefully double check that, you will kind of use the benefit of quick thinking, but also the benefit of slowing down and analyzing it carefully. The advantage of that is the instinctive feeling is quite often correct, right? Especially if you build up that experience. And it's quick. So you can flip through the charts and something grabs your attention, you're probably on to a good start. But as a beginner, you don't have that experience built yet to use that. And you have to be very careful with that. And you want to triple and quadruple check that, right? The more experience you have, maybe the faster you can do the checking and the type 2 thinking. And that could even become a bit quicker again. All right? But it's always good to double check and use both. And that's the key here, is using both, in fact. In this case, I talked about quick and then slow thinking, right? Instinct and then critical thinking. But you can also use it the other way around. You can start with critical thinking, all right? Make your plan, be ready, and then act on whatever you had prepared. In fact, that's always needed. Once you have critically gone through the charts, compared the charts to your trading plan, chosen the ones you're interested in, and you're ready to trade, let's say, the pound dollar on the hourly chart, at the beginning, you should be ready to act. Because if you start second guessing with your type 2 thinking, with your deliberate thinking, after you've done the analysis, you're going to be slowing yourself down too much. And you'll not be ready to actually react. You need to be in a phase of reaction time as well at one point. Because otherwise, you'll be in a continuous circle of doubt and of rethinking and reanalyzing, and you'll let go of that phase. So analyzing is great, and using critical thinking is very important, as I just showed. But eventually after that, you have to set that aside, go with that analysis you did, and then act on it when the time is ready, of course, according to your plan, and act to that plan with resolution and no hesitation. All right? So in many ways, it's ideal to combine instinct and critical thinking at various times. Once you have completed the thinking, though, the slow thinking, be ready to act. Of course, after some time, if this trade setup takes long or if it doesn't get triggered for a long time, then return back to deliberate thinking and reanalyze if the setup is still valid. That is fine. Of course, at a certain point, you can even stipulate it beforehand, you want to step back out of your acting mode, right, out of your reaction setup, and rethink it. Is it still good? If it is, and you have a green light, you can go back into your action stance, right? You'll be ready for action. But perhaps you find out you have a red light and things have changed. So you stop that particular analysis. So it's always that back and forth that's very important at the right times. Thirdly, regarding exits, it's very, very tempting to expect more profit, to cut winners short. These are all very, very easily, traps we make for ourselves. Some solutions for that. Now, first of all, set and forget. So the only thing you have to do in that case, and that's not easy for everyone, is follow the rules very strictly. Set and forget. You don't have to manage it. You just have stop loss, take profit, and that's it. So just stick to that, and your strategy should then give you that edge. Of course, the disadvantage of that is that there's new information available. Each and every candle that's there will give us more information, but we can't use that because we have a set and forget. So I don't think personally, from my experience, it's not optimal. It's still good, especially if you're a beginner, I think, or if you have maybe less time for the markets, it's good. If you want to optimize it, I think it is worthwhile to learn how to manage the trade. I do think that has a better equity there to grab, but both are valid. If you do manage your own trade, some things you can think about how to manage them is time factor, as I said, how long is a trade lasting, a balanced confidence, not too overconfident, thinking, oh, this trade is going my way. You see, I totally rocked the market. Or underconfidence. Oh, I finally have a few pips. Finally, right? And you're kind of underconfident. So that does take time, but always keep that in mind that and try to learn to get that balance. Don't be over greedy. If you have 40 pips in your pocket or 50, don't think that 60 is a guarantee necessarily. So I think it makes sense to use trail stops, to use profit stops like Nana does, and especially when price gets close to your take profit zone or closer and closer, it makes sense to actually lock in more and more profit, in my view at least. All right, so same thing as if the trade is taking too long. Don't be scared to take a very small loss. A few pips loss is not the same loss as losing 100 or 50 pips. It's all about the ratio. If you lose 1/10 of your original risk, that's like a break-even trade. It's a small loss. It's not going to hurt your account if you have proper risk management. Realize that for us traders, however, taking a small loss still feels like a loss. So your psychology is going to trick you into thinking that that is not good. It's painful. And it's just very, very good feeling to avoid losses. But rationally speaking, it's a lot better to take a small loss rather than keep the original risk on the table and hope for the best and see the whole trade end in the big loss. Right? So try to balance that in your mind as well. So when I look at the markets on Monday when doing the recap video, this is 2 screenshots of before on the right and after on the left. And what I try to provide is a sentiment of what I think is going to happen. So with the pound dollar, for instance, I saw momentum to the downside, and I did not think it was a good time to trade because I thought that there should be a pattern first. The momentum has lasted already quite long. So from my perspective, the probability of a bounce was high, but I expected a sideways bounce. And then I was looking for a breakout trade to the downside. So my analysis in this case was confirmed when price indeed started to make these candles like this, as you can see. All right. So by price going sideways, it confirmed my analysis. Great, right? So that's perfect. In this case, my analysis was close to what the market indeed was directed to. I listened to the market and everything was okay, and you got one more lower low. Then the market made a retracement. With the dollar yen, I also thought the probability of a bigger correction was higher, at least to test the S1 at the bottom here, if not break the bottom and go to lower pivot points, as these red lines here indicate. And indeed here too, I was indeed looking at a correct assessment of that analysis, right? So those are two examples where the market was doing what I expected. But let's take a look now. Sorry, let me change to live screen. And I'll just quickly look at my charts here. Sorry, move my charts so you can see it. All right. Let's see. Euro dollar. Let me use a different template. This is a bit crowded. Alrighty. So for instance, euro dollar here, I would always use decision zones myself for understanding what is the most likely key levels. Point of confluence, for instance. Then also in his technical analysis, you will see key levels, and in some cases arrows to both sides, right? Depending on the break or bounce of those levels. Same thing. So when looking at the euro dollar, for instance, I was saying that I'm not interested in the euro dollar in the Monday's video because I want a break of this trend line or this trend line, I said, right? And then I would expect basically price to reach the S2, right? Reach the bottom here like this. All right, now I was not a big fan of the euro dollar because of the choppiness, and I realized that there was a range and things could go wild up and down. So part of this did happen. It did break. It did not break here. It failed. It bounced in this case. Then it reached the bottom. It bounced a bit, but then it broke. But the break did not go all the way down to the main target, the S2 and this trend line. It stopped actually halfway and stopped at the S1. Or I'm not sure, that's maybe today's S1. I'm not sure where the pivot points were yesterday, but doesn't matter. It stopped about halfway. So if I were not flexible in my viewpoint, and I would see a candle like this, right, a huge candle, there is a bit of a wick, but otherwise it's bullish, and it engulfs all the bearish candles before that, I would not be flexible enough to recognize that this breakout is probably not going to go, there's a pretty good chance that this setup is not going to go to the original target. It's not going to make it there. The market did make a nice decent run of about 80 pips, but things changed. The market is flexible. It doesn't have to do exactly or go exactly where I want it to go or think it will go. The market went 80 pips, decided to flip around, and I can see its intentions, the market, by just simply looking at candlesticks, right? Very simply right here, price showing that that's probably it, and it's not going to get down there. So if I'm not flexible, I would ignore that information and hope for the best. If I am flexible, I realize that if I'm still in that trade and I didn't grab some profit, that it's time to exit for a small profit, for break even, or even a small loss. I would, in that case, realize it's time to manage the trade, trail the stop, partly exit the trade with some profit, move the rest to a stop loss, etc. All right, that I'm not, that's something that Nena does very, very accurately. Is when he's in profit, there's little times that the market catches him by surprise and he sees a profit roll back into a loss. So he's very good in being flexible and not greedy and catching those pips that the market gives to him. I think that is critical thing you can learn from as a trader, and Nena does that very well. So that's something that maybe Nena we'll talk about still in his part. which I'm going to actually share with him right now. So if Nenet's around, then I'm going to pass the presenter. But as a last note, this is one of the things, decision zones and reactions at the decision zones is what I'm looking for to take the bias. And not only at the entry of the trade, but as the trade continues as well, the management of the trade as well. Time and price action is what I keep an eye on. All right, let's see if Nenet's around. Let me pass over the presenter.
Thanks,
Hi, Nenet.
Chris. Yes, here. So, well, that was it, guys, from Chris. Excellent, as always. Now we're gonna see this part where I will be giving you some examples for trading bias, and also some things generally about different biases that might exist and that you should be paying attention to. We've all been there, and we all know what can happen if we have a bias, so it's not a good thing to have it, but also, guys, it's not a good thing not to be aware of other people's bias. So let's see. First thing is, definitely it's not good to have a trading bias. For example, I remember a guy from Forex Factory in 2008, while euro dollar was dropping like a stone. He was actually going always long and long. His nickname was Kaiser, I think, and there was really a big debate between him and other traders on Forex Factory. And well, the guy definitely came to memory because he was totally biased trader. He was he had the right about some things, of course, that the drop that was during the global financial crisis, that the drop in dollar will not be always substantial, and euro dollar was going up and up and up. Then suddenly he started to change his bias, and everyone was, well, how the hell happened? What you were talking about the dollar strength, now you're changing your bias. So definitely I noticed that the guy was guided by his trading bias, and it was not that good. I mean, the main thing is euro dollar made its peak then, and of course it started to drop. I mean, there was some correction in the market, and you definitely needed to see his reactions. That was very, very funny. And I mean, the guy was overly confident in strength of dollar. That happened, but it happened later. So his technical analysis was not good, guys. His fundamental knowledge was okay, but his technical analysis was really not good. And euro dollar, after having a big peak to the upside, it started to drop, and then he switched his bias again. So it was not good. The main question was then also in Forex Factory, is technical analysis better than fundamental analysis? The thing is, you cannot always say same thing. What is better? Okay, everything has its own merits, but in my opinion, for intraday trading, and especially for intra-week swing positions, technical analysis has, and you can see that, guys, from our analysis, technical analysis has the advantage. It's always the best when both technical and fundamental analysis align. So for traders who are still thinking whether technical and or fundamental is better, for intraday and intra-week, technical is better, of course, but the best is to have alignment of technical and fundamental factors. Okay, that is always the best. Looking for bias confirmation also. Well, you can look, but search for bias confirmation from the people who trust. Chris, me. You should definitely pay attention to our analysis, not to every single analysis you can read on the market. Also, trading bias is reading a different forum or different forums, because it's called herding bias. Many people will definitely go and listen to other traders' opinions, and they would neglect their own opinions. That is not good. And emotional bias It's when you are emotionally attached to a trade setup or to a certain pair, and you always want to trade the same pair all and over again, every single day, every single time. It's not good, guys. It happened to many, many traders. Also, back, I remember in Forex Factory and Euro-Dollar Thread, everyone was trading Euro-Dollar back in 2008, 2009. What about other pairs? They simply didn't exist to that extent. So that was emotional bias. Trading only Euro-Dollar, trading only Pound-Dollar. Why? Why would we do that? Sometimes we won't be seeing any action on Euro-Dollar. Sometimes we won't be seeing any action on Pound-Dollar. So we need to trade Australian dollar, New Zealand. Why not? Right? So don't have emotional bias. There is no professional Euro-Dollar trader. There is no professional Pound-Dollar trader. You're either trader or not. For me, I don't care, really. I can trade Euro-Dollar. I can give you the analysis and trade Pound-Yen. I like Pound-Yen more than Euro-Dollar, honestly. So, you know, I don't have emotional bias. Just because I like Pound-Yen, it doesn't mean that you will see Pound-Yen analysis each day, because it's not possible to have a good movement each day. Euro-Dollar was good today. So we did Euro-Dollar, right? Selling it from 1.067080. Today, it was good. Tomorrow is another day. So I'm not biasing. I don't have any bias. What is emotional bias? First of all, it's overconfidence, guys. Overconfidence. You are always overconfident that something will be good to your account. Something beneficial will happen to your account. That's not good. You can also be overconfident and think that your trades are unmistakably good. Well, you're wrong, guys. No one is right 100% of the time. Neither am I, so overconfidence is not good. I know a lot of good traders, really, who simply lose because they are overconfident. Well, I was in a part of my life also overconfident. I remember the time, it was 2011. And because really I cannot remember when I had a loss. I remember a time, yeah, 2011 or 12. I think it was 2011. I had a winning streak of 36 trades in a row. 36 trades in a row without a single loss. And those were like one or two trades per day. It was not like making 15 scalps and all of those scalps were successful. So I had a winning streak of a month without a single losing trade. And then, of course, I was punished normally. I mean, for me now it's normal. But you know, I was so overconfident that I will win every single trade, and I started to leverage my positions. So instead of going with the risk that I normally used, I tripled the risk. Not doubled, I tripled the risk. And of course, my profits for that month were wiped out in 3 or 4 days. That is, guys, what happens when you are overconfident. Of course, it took some time to learn that. I took a punishment from the market, but well, today you won't be seeing me doing that. Of course, I'm not overconfident. I'm just confident in my methods. And I believe in myself and my analysis. But I'm not overconfident. Confirmation bias. Well, also, I knew a trader that he was always paralyzed by analysis. He couldn't make any trade because he looked for too much of confirmation. And when I asked him, okay, can you give me, please, a signal where you enter the trade. Because I remember it was also back in days when I was actively discussing with other members, of course, Forex Factory. That was, I mean, I am a long-term member of Forex Factory, and we discussed a lot of things there. So it's not just a coincidence that I always speak about Forex Factory. So I said, okay, can you just send me a signal when you enter the trade? Because he was giving like signals, entry, stop loss, something similar, guys, that I give you with session recaps. And his signals were very good, really. But when I asked him, okay, now you made some money, you might be rich, I don't know, because, well, you know, he was very good in that. He said, no, I didn't make any money. Privately, he sent me a message. I took like 3 or 4 trades only. And I asked him why. He said, okay, that was a signal, but I wasn't confident in my own analysis, so I needed some other confirmation, like from other traders, or confirmation from, I don't know, some sources of signals providers back then. So guys, it was a bit strange. And now I know that actually there are traders who look for confirmation bias. Then I met another trader on Forex Factory. He was a very good trader. His name was Red Sword. He had a very good thread, and the thread is still there. Price is everything was the name of the thread, and it's still active thread, I think, on Forex Factory. One of the best threads really for price action. And Red Sword, we call him Red, he was really a good trader. I mean, at least what he was posting about, it had some logic. But definitely he suffered from illusion of grandeur or grandeur, how French, it's a French word, so I'm not good in pronunciation. But that term, illusion of grandeur, well, it's a term for people who think that they are gods in trading. And it's not like he was just overconfident. The thing is that Red was a good one, good trader, but whenever he misses a trade, or you tell him otherwise that he might be wrong, he starts attacking you, and a lot of his posts were extracted from the original thread, because guys, simply, he's like Mr. Jekyll and Hyde. He turns into another person when you say that his analysis might be wrong. And I mean, you can tell him calmly to calm down. You can tell him in a nice way, not saying like, okay, your analysis is wrong, you're a bad trader. It sucks, right? No, you just tell him, okay, your analysis might be wrong, and he starts to attack you. He speaks a bad language. He doesn't mind the language. He tells you that you are a peep, you know. I cannot say publicly, but you know what I think. And definitely, I knew that, well, guy, he's okay, but what can I tell to him if I see that his analysis might be wrong? I'm not able to influence him. I'm not able to actually say anything, because I was afraid that he will attack me, you know, verbally. Because, guys, when you are a member of a Forex Factory, is huge. It's huge. And when you are influencing member of a Forex Factory, and people do listen to you, you cannot afford yourself to get into a verbal discussion that uses bad language. You simply need to avoid it. And because of that, I stayed sideways. I kept my low profile, you know. So that is illusion of grandeur. If you think that you are God in trading, you think wrong, guys. No one is God in trading. Yes? And Goran is saying, he read the topic, price action. He was a little eccentric person. Yes, he was okay. I mean, his trade was good. I can testify that. I mean, guys, I'm a price action trader and analyst, and I can always say if something is good or something is bad, right? But I never ever think that I'm a god, that I can do whatever I want with price, because simply it's not truth. I mean, we always try to find some things that will give us profits. But we are also wrong sometimes. Not just in analysis. I mean, analysis is okay, but very often we are wrong when we want to make some big trades. You know what I'm talking about. When you try to over leverage your position, usually it goes wrong. Well, it's psychology. Herding bias. Ilya is saying you're not God, but almost Chuck Norris of Forex. Now you made me laugh, Ilya. Well, Chuck Norris, yeah. Well, he was good back in days. His movies I like a lot. When I was a kid, I watched a lot of his movies. Well, he was like action hero of our time. Arnold Schwarzenegger, Sylvester Stallone, right? Chuck Norris, yeah. Gambling bias, guy, herding bias. Herding bias is when you always follow forums to try to actually find confirmation for your trade. And if you read other people's opinions, then you will be wrong with your own assessment. So don't do that. You can follow few people, guys, but please do not follow like 200 people or even 10 people is too much, because you won't have your own trading decision. You will just follow the herd. So don't do that. There are a lot of different analysts. There are a lot of different signals in the market. Just follow a couple of people who you trust the most. Gambling bias. This is good, guys. Yes, I will just go in details here also after this. Gambling bias. This really needs to be delve deeper into it, and I will tell you just when I cover overconfidence. Because gambling bias it's not a bias. It's something that it's inherited. I mean, inherited in trading part of your subconsciousness. So it's a little bit different. Overconfidence also can make you euphoric, guys. Do you remember when we actually when we talked about emotional spiral? And I always said don't trade when you are euphoric, because when you are euphoric, you tend to make over leveraged trades that will definitely that will not give you peace of mind. When you are euphoric, you're usually on winning streak, and you need to back down, unless you want to suffer from a huge loss. Euphoric decisions are always worst. I personally really am not euphoric about any trade, simply because my risk is very low. So really, I even if I win like 70-80 pips, I'm not euphoric, because you know it's when you do low risk trades, you should definitely be more calm down. Definitely more calmer. I'm the best. Well, no one is the best. There is no best. People who won championships in trading usually are not that good traders, because trading on demo account, it can be good if you trade like it were a real account, but if you go on a championship with a demo account, then you actually are gambling. So usually people who won those championships on real accounts are not doing that good. Yeah. Also, big positions. Don't go for big positions, guys, even if you think that your system or method of trading is awesome. Okay, don't do that. And never ever overtrade, because overconfidence will make you overtrade. You will be making more trades and you will be depleting your account. The question from Nywin: what if you see the setup that you always trade but you're euphoric? Should I not take the trade? Nywin, you should take the trade, but please do it with low risk. If you think that your setup is good, take the trade. But don't be euphoric in a sense. I want to take the trade, but I will risk 3 times more than I risk normally. Because you know, if you trade with 1 lot, you might take on euphoric trade 3 lots. Don't do that. Just simply say, okay, this is good. I think this setup is great, but enter the same amount you always do. Don't risk double. Don't risk triple. You can slightly adjust your risk, but don't do it like double or triple. It's not good. Especially if you're euphoric after a series of 10 wins in a row. Don't go for 11th win. Wait, there is another day. Goran is saying he thinks that people should have personal qualities in order to be good traders. Indeed, those qualities that can qualify also for a good trader are definitely coming from your psychology, from your inner self. So yes, I can say that, Goran, you're right about it. Confirmation bias, paralysis by analysis. I always said, don't be paralyzed by analysis. If you think that you should enter the market, go enter the market. Lower your risk and be calm. Don't be too careful, because if you're too careful, you will be missing a good setup. And if you miss a good setup, what can I say, really? Then you need to wait. You need to wait for another trend setup. You need to wait for a scalp or counter trend trade. So don't be too careful. Don't be too scared to enter, guys. I mean, I know a lot of people who are listening here, who will be listening this on YouTube. Don't be, guys, too scared to enter the market. Just press buy and sell. If you do it with low risk, you will learn to be calm. You will learn patience. You need to believe in your setups, your system yourself. If you don't do that, practice it. Open small account and trade smaller. If you can make money on small account, the principle is the same on big account. You just take higher lot size, you enter with higher volume, but the principle is the same, really is the same. Kertu is saying, as a beginner, is it still okay to follow 2 pairs? Kertu, you can follow 2 pairs as beginner. You can follow 4 pairs. Euro dollar, pound dollar, Australian dollar, and dollar Swissy. But please learn over time that you can also follow Euro yen, pound yen, Australian dollar, New Zealand, Euro, Australian dollar, New Zealand yen. So stick to 2 pairs, but gradually increase it. Illusion of Grandeur also, guys. We talked about illusion of Grandeur, but we didn't say that delaying profit taking. It also happens from people who suffer from this illusion or delusion. The problem is that if you don't take your profits, if you think that you can make 200 pips instead of 60 pips, just because your analysis is okay and you've been doing good, well, you're still wrong. Because markets have changed. If ATR, average ATR of a single pair, it doesn't matter which one, just as an example. If the average ATR for last 14 days was 100 pips, do you really think that you will make 200 pips in a single trade in a single day? Think about it twice. No stop losses. Well, that's pretty much obvious for traders who simply don't like to lose, who can't afford to lose, even if no one is watching them. Guys, losing is a part of trading business. Bank traders lose, guys. Hedge fund traders lose. Learn to accept the truth. Learn to accept the fact. Listen to market. You cannot trade without a stop loss. I mean, you can trade. If your risk is 1 or 2% and you monitor your trades, so you can take trades, you can stop your trade manually. But usually if you want to protect your account, You need to have stops. You need to know where is that stop you should place your trade to. What is the stop loss? Is it 30, 33 pips or 50, 55 pips? Stop loss is dynamic, while risk should be static. No stop losses mean that you are really either gambling or you are overly confident. I will answer questions just after I show you slides. Herding bias. Always listening to others. Well, listen to others, but not always. Search for different forums. If you want to use forums, guys, stick to one forum. But you know what the problem is here? Bad trade, another search. What it means? If you follow a trader or analyst and he makes one bad trade, you tend to follow other people. Still wrong. Everyone can be wrong, so don't search for other. Stick to your favorite analyst or trader. But do not follow tens of them, dozens of them. It will cloud your own judgment, and you might start to make some emotional decisions into the market. Okay? So don't do that. Just believe in yourself and confirm your views with few chosen people. Okay? Gambling bias. Now this is what I wanted to say. Gambling bias. Pure gamblers are pure gamblers. Pure gamblers always make pure gambles. They cannot trade otherwise. They deliberately don't care about risk. It's not like you need to differentiate between traders who gamble and gamblers. I'm certain that 100% of you guys who are here today, at least once in their trading life, gambled. You know, not like you want to gamble, but you gambled. You said, okay, I will take this trade. I maybe not will use stop loss. I will put bigger risk, and whatever happens, I hope that it will be best. I hope that it will be for the best. The sentence, I hope, qualify you for a potential gambler. And I'm sure that you all did it at least once. But the difference between you and gamblers are that gamblers are bored. At least their psychology is they don't care about risk. I can tell them, guys, listen to me, go with lower risk, be rational, try to trade as banks do. They don't care really about what I'm saying, what anyone is saying. They don't care about banks. They are gamblers, guys. They will try to seize every single opportunity in the market. They cannot trade other than gambling. There is no way. They will be overtrading every single time, doing it with leverage, big leverage, revenge trading all the time. They don't care really. If they lose, they will double their initial position and they will gamble. For them, it's normal. And the habit, it's impossible to change. You cannot change their habits. They will be gamblers. They have been gamblers. They are gamblers, and they will always be gamblers. If they cannot gamble in Forex market, they will not trade Forex market. Simple as that. They don't care about price, technical analysis. Give them system, give them money, and let's play. Well, you know, those are gamblers, real gamblers. It's impossible to change. And finally, listen to market, guys. Listen to market. This is what I will be showing you now. Listen to market. What did I tell you today about euro-dollar? Okay. I told you sell euro-dollar, guys. Okay. That was my analysis today. I knew that it was going up, right? And but I listened to actually what market had to say. I was telling you that I will be shorting rallies. I mean, tomorrow we might see some change because tomorrow is profit taking. We might see maybe at the break of this if it continues to go up. But today I said short rallies here, okay? Because what I did is actually I listened to market. I didn't care about momentum because momentum was purely to the upside, right? But I care about market. I always listen to market. I closed euro dollar, of course I did. I'm not trading it now. I mean, I had to close it because I was profit stop, as Chris has explained. I usually use profit stops. But it dropped nicely from this resistance. Guys, H4 Camarilla daily resistance, top of ATR. If you watch 4-hour time frame, what does history tell you? Sellers, not buyers, right? Although price was going up, just watch this. Watch this. Price repeats itself. So this was actually spot to sell, not to buy. So that is why I gave you the analysis to sell, and I explained also in full article. We can change ATR. It's actually 14 days, but it's very similar here. See, almost to the pip. So market told me in the past a lot of sellers showed here 300 pips. In the past a lot of sellers showed there 300 pips. Now we also have, I'm not aiming, and I didn't know that it would stop here. I said the target was 0600, but if it had proceeded below, then other levels would have been hit. But the first zone, target zone, was almost hit. So it's still congested here. It might happen that it could spike. We will see tomorrow. But for this day, this was good. Another thing on session recap, I said go long at 1.20, 120. This was session recap, and here the price hit our entry and went up. Okay, the market was going down heavily, but we didn't catch a falling knife. What we did actually, we went with counter trend trade opportunity, because in the past there were tons of buyers here at 21.20. And also at that time 21.20 was the bottom of ATR, and it was clear that it might reject from 21.20. Kertu is asking me, how do I read ATR? I did a webinar, Kertu, so please refer to webinar about ATR. Also, I uploaded webinar about counter trend yesterday, so please go ahead and watch it. There you will find info about ATR. So guys, that is how you do it. So don't have a bias. Try to know what the markets want to tell you. Listen to people who you believe. Lower your risk when you trade, because then if you're wrong, you will have more realistic chance to recuperate without risking too much. And enjoy trading. This can be very nice part-time job or whatever you want to do with it, just if you know how to do it properly. Try to tip the odds to your favor and try to balance your emotions, because people lose mostly because of bad money management that is directly connected to their emotions. Thank you guys for listening to me. This is everything that I had to say. Thank you for listening to Chris. We are finished with today's webinar. Tomorrow we expect new analysis, and I hope that I will see you again. Okay, Monday session recap, Chris webinars, and we will do more pips. Thank you guys, and as always, trade safe. Cheers.